Struggling to understand price charts? You're not alone. In this video, I'll break down key technical analysis concepts so you can read any chart with confidence and make smarter trading decisions. Here's what we'll cover: candlestick patterns, market structure, support and resistance, and chart patterns. Let's get started. Before you can make smart trading decisions, you need to understand how the market communicates. And the first thing you need to learn is candlestick patterns, the foundation of price action. Every candle tells a story about buyers and sellers, momentum, and potential reversals. If you can read these patterns, you'll know what's happening in the market before making a move. Now, let's break down the most important candlestick patterns you need to know. One of the most powerful candlestick patterns every trader should know is the hammer. It's a bullish reversal pattern that signals the potential end of a downtrend and the start of an upward move. So how do you recognize it? A hammer candlestick has a small body at the top, a long lower wick, little to no upper wick. This tells us that sellers pushed the price down, but buyers stepped in and forced it back up, closing near the high. That's a strong sign of buying pressure. Just like the hammer signals a potential reversal to the upside, the shooting star does the opposite. It warns that a downward move could be coming. It's a bearish reversal pattern that appears after an uptrend and signals that buyers may be losing control. So, how to recognize a shooting star? A small body near the bottom, a long upper wick at least twice the size of the body, little to no lower wick. This tells us that buyers tried to push the price higher, but sellers took over and forced it back down, closing near the low. That's a strong sign of selling pressure. Unlike the hammer or shooting star, which signal clear reversals, the doji represents indecision in the market. A doji is a candlestick pattern that signals indecision in the market. It forms when buyers and sellers push the price in both directions, but by the time the candle closes, neither side has won. The result is a candle with an open and closed price that are nearly the same, creating a very small or non-existent body. The key characteristic of a doji is its long upper and lower wicks, showing that price moved up and down before settling back near its opening level. This pattern often appears after strong trends or in consolidation phases, signaling that the market is at a decision point. The engulfing bar is one of the strongest candlestick patterns that signals a shift in market control. It's a two-candle pattern where the second candle completely engulfs the previous one, showing that either buyers or sellers have taken over. A bullish engulfing appears after a downtrend. The first candle is red, showing that sellers were in control, but then a much larger green candle follows, completely covering the previous one. This tells us that buyers have stepped in with strong momentum, overpowering the sellers, and a potential reversal to the upside could be underway. On the other hand, a bearish engulfing happens at the top of an uptrend. The first candle is green, indicating buying pressure, but then a much larger red candle follows, completely swallowing the previous one. This shift shows that sellers have taken control and a potential move downward could be coming. An inside bar is a candlestick pattern that signals market consolidation and a potential breakout. It forms when the current candle is completely contained within the range of the previous candle, meaning its high is lower and its low is higher than the previous bar. This shows that the market is in a temporary pause, with neither buyers nor sellers pushing price beyond the previous range. Inside bars often appear after strong moves, acting as a moment of indecision or a build-up before the next big move. When price eventually breaks out of the inside bar's range, it can signal the continuation of the previous trend or a possible reversal. The evening star is a powerful bearish reversal pattern that signals a potential shift from an uptrend to a downtrend. It consists of three candles and forms at the top of an uptrend, warning that buyers are losing strength and sellers are taking control. The first candle is a strong bullish candle, showing that buyers are still in control. The second candle is a small-bodied candle, which can be a doji or a small bullish or bearish candle, indicating that momentum is slowing down and indecision is creeping in. The third candle is a strong bearish candle that closes deep into the body of the first candle, confirming that sellers have taken over. The morning star is a bullish reversal pattern that signals a potential shift from a downtrend to an uptrend. It consists of three candles and typically forms at the bottom of a downtrend, indicating that sellers are losing strength and buyers are stepping in. The first candle is a strong bearish candle, showing that sellers are in control. The second candle is a small-bodied candle, which can be a doji or a small bullish or bearish candle, indicating indecision in the market. The third candle is a strong bullish candle that closes deep into the first candle's body, confirming that buyers have taken over. Now let's move to the second part, which is market structure. The market doesn't move randomly, it follows a structure. Recognizing this structure helps traders understand what's happening and what could